This is the BiggerPockets Podcast, show 917. What's going on, everyone? This is David Greene, your host of the BiggerPockets Real Estate Podcast, the show where we arm you with the information that you need to start building long-term wealth through real estate today. And I've got a surprise for you. We've got a Seeing Greene episode. That's right. In today's show, if you've never heard one before, we're going to take questions from you, the listener base that sent them into me directly, and answer them for everybody to hear. In today's show, we get into if interest rates justify holding a property that's not performing well, or if you should reinvest that money into better opportunities, what to do with $70,000 if your job is to escape the rat race, and a little back and forth going on in the BiggerPockets forums, what to do when you've got a bunch of equity in a BRRRR, that's a BRRRR property that's now a short-term rental, and more. Up first, we've got a flipper wholesaler who is looking to expand into multifamily and storage. He wants to do all the things and wants to know where he should start. Most importantly, though, if you want a chance to ask your question, please go to biggerpockets.com/David, where you can submit a question and be featured in the show. If you don't remember what I just said, we also put the link in the description. I love it when you guys listen to me. Thanks so much for submitting your question. Let's kick this thing off. All right, up next, we have Mike Larson out of South Carolina. He was featured on episode 275 of the Rookie Podcast, and he's here joining us on Seeing Greene today. Mike, what's your question?
What's going on, guys? Well, first, I just want to say thank you for having me. This is truly a ton of value. Right now I own a small wholesaling and flipping business, and I've built up the systems to, find single family homes. But I want to start to scale into like storage and multifamily. And, I use your basic marketing, cold calling, texting, PPL, PPC, direct mail and stuff. But how are you guys marketing and finding like properties that are 10 plus doors or storage facilities that are 100 plus doors?
James, what are you doing to find these? You got like a whole bunch of apartment complex doors, don't you?
Yeah, we've been buying a lot the last 24 months too, even with these high rates. One thing that we've learned, and Mike, I started the business doing what you're doing. We had a wholesale business, fix and flip, brokerage, and we were always the people self-generating our own deals for small multifamily, fix and flip, any of the residential space. But then as we started to grow our doors, what we noticed, at least in our market, is we had to expand our network, because large multifamily a lot of times is a smaller group of brokers that actively know that product. So the good thing about commercial brokers or multifamily brokers, they're not as wide as we are as investors. And so when you get into that space, you want to kind of expand your network, and so again, I self-generate a lot of my own product with cold call rooms, direct mail, door knocking, referrals from other investors. But where we get most of our larger multifamily, once we stepped in that space, is those commercial brokers, because commercial brokers work specific areas. And because there's only so much product in a lot of those areas, they know the sellers a lot more. And by getting to know your seller leads more, just like you do with wholesaling, you get higher conversions, right? If you know what's going on, you're staying in front of them. And so we've had really good luck just working with our commercial broker network and multifamily broker network, always bringing us deal flow, because a lot of times these multifamily properties do never hit market. They're trade off market. These guys are good at finding the opportunity, selling it. They're motivated by their commissions. And that is by far the most product we get is from our broker community.
What do you think, Mike?
Makes sense to me. I mean, I'm good about the networking aspect as far as what I've been doing so far, because I'll hold, once a month, I'll do a meetup to try and meet other people in the market and have other wholesalers send me deals. So I guess I could just do the exact same thing as far as, going after the commercial brokers, try and meet up with more of those guys.
So you mentioned the similarities. Like you said, you network with residential people like wholesalers and agents. Now you're going to be networking with commercial. Here's the differences so that you're not walking in blind. Most wholesalers and agents aren't worried about if the person asking about the properties is a serious buyer, because it's not hard to get financing for residential properties. There's a million different loans that you could get. Right now, you got people that are putting together money and they're throwing it at investors, just like, please take my money. There's more money to lend than there are deals are. When you walk into the commercial space, those brokers are going to be way more concerned that you're a tire kicker, that you're wasting their time, that you're not a serious buyer than what we residential investors get used to. So you're going to want to understand their vernacular. You're going to want to get like cut to the chase and be able to portray yourself as a serious person. This isn't like, real estate agents are willing to give me a free education in real estate, hoping that I become their client. These are sharks. They're only here because they spend their entire life building relationships with wealthy people that own these commercial properties. They're understanding what triple net leases are, the different financing options with these things, how you're going to improve the net operating income. They're going to use phrases that you may not know if you haven't gotten involved in this. And if you're staring at them blankly, it's a really good way to lose the trust. And then that deal's not going to you. It's going to someone with a proven track record. You kind of got to fight your way into the good old boys club if you want to be a commercial investor.
Yeah. And the reason it's like that too is these commercial brokers are working this targeted area. And they have a lot of times they have a small group of sellers, and they don't want to jeopardize that relationship they've been working on for 2 years. So that's why they want to vet you correctly. But as you go into markets too, other things, commercial brokers, they can be a little standoffish sometimes. And just like David said, you want to kind of qualify yourself. But if you're getting some pushback or they're not bringing any inventory, other ways that we do target multifamily, and Mike, if you're a wholesaler, you could definitely do this because you know how to target direct to seller targeting. A lot of times we like to pull the recently rented properties and then we pull the information on them. So like, let's say an apartment building is renting for $1,000 a unit. We pull that tax record up because that looks below market value and we see when they bought it. Then we can look at how much they've depreciated from that property based on, if they've been there 10 years, they've depreciated most of it. Then we're looking at their equity position and we run the return on equity. And that's what we approach these sellers with is going, hey, we have an opportunity for you. You have almost a fully depreciated building. Right now you're collecting this much in rent with this much equity, which is this return. And usually it's going to sound pretty low, 1% to 2%, because it is. And that's how we get these multifamily sellers to at least start listening to us because they're more sophisticated than your usual single family seller. And when you're talking to them about buying their property and you're giving them the information, they already understand the benefits of depreciation and return on equity, but they just don't realize it sometimes. And so by summarizing it, it can get them to kind of work with you a little bit more. And so those are ways that we're looking for because we can call them with an opportunity. They should upgrade their portfolio. We want to buy. And so those are a good target list. And another really good way to kind of find more multifamily is to reach out to multifamily property management companies. Say, hey, look, I'm looking to buy. If you put together the deal, I'll use it as a broker and I'll keep your property management in play. They have a lot of sellers that, it's in their best interest to sell that, get them into another property anyways. And they might know landlords that want to move. And it's another good way to dig out deals without having to pay all the broker fees.
That's genius. I love that.
There you go, Mike. Thanks a lot, man. Appreciate it. And good luck to your nephew in his wrestling tournament today.
Thank you, sir. Thanks, guys. Have a good one.
All right, James. Now, we sort of covered there with Mike that the networking component is different with commercial than residential. The financing component can be pretty different too, especially when you're a residential investor that's used to buying distressed properties. Can you kind of cover what people can expect in financing differences if they make the jump from residential to commercial?
Yeah, a lot of times, especially when you're buying those BRRRR multifamilies 2 to 4, a lot of investors, including myself, you utilize hard money and construction loans because you want to buy it, it's below market, increase it with the construction funds, and then refi it into a permanent loan. Commercial's just it's a lot different, right? Because you're not getting 30-year financing typically on these buildings. They're commercial loans that have balloon payments at 5, 7, and 10 years. And typically when we're buying these multifamily, small or large, we're working with local banks. And that is a big difference between your residential lenders too. When you're getting your commercial financing, you're actually meeting with your bankers, you're talking to your local bank, and they're looking at it like an actual asset. Whereas if I'm getting a residential loan, I'm dealing with the mortgage broker who's making sure that I'm packaged up right, and they're dealing with the bank. And so, commercial, as you get into multifamily, these relationships with local banks are really important. It's good to go meet with them, establish them, move some deposits over. The more you get to know them, the better leverage they would get. And when we buy value add multifamily, it's always a 2-step loan, but it's rolled into one transaction. So when we buy these properties, we set it up with a bank financing. They give us a construction component. It's interest only, a little bit higher rate, but it's about 3 points cheaper than a hard money loan. When we close on that loan, we've already had our permanent financing locked. So we know when we get done with the stabilization, what our interest rate's going to be. And I do think that's really important for people to look at as they get into multifamily. You don't want to buy a property without a locked rate. Because if the rate changes, your performance is going to change. And so the beautiful thing about multifamily is you can get your construction loan and your perm loan all locked in one. So you can actually reduce your risk, but you want to work with a local bank that understands multifamily and does construction.
There you go. Another little perk that I like with that is if you're maybe unsure of your underwriting or the process of buying commercial properties, if you're going the route you're saying, James, you have a couple other sets of eyes looking at the deal that you won't have yourself, right? It doesn't hurt to have more experienced people looking at it and maybe saying, hey, this could be a problem, or we would want to see this become better, because you'll learn from that experience. Great point there. All right, in this segment of the show, I like to take questions from the BiggerPockets forums or comments from YouTube or reviews that people left wherever they listen to podcasts and share them with everybody. Today, we're going to be getting into a question from the BiggerPockets forums. Which real estate strategy works the best to escape the 9-to-5 rat race? My question for anyone that escaped the 9-to-5 rat race is, what real estate strategy did you use? For example, if you had between $20,000 to $70,000 to invest in real estate, how would you use that to replace your income of $7,000 a month from your job? Would you do fix and flips, tax liens, mortgage notes, buy and hold rentals, Airbnbs? What would you do? They then go on to say that they think house hacking would be a great strategy, but they prefer tax liens and short-term rentals. Now, Abel Curiel from Queens, New York responded with, hey, Rodney, great question, and you came to the right platform. Each strategy that you listed requires different experience, risk tolerance, networking connections, project management, and initial capital to invest. Have you tried looking further into those strategies? I'd suggest that you weed out the ones that don't fit your end goal and your schedule. Rentals and Airbnb seem to be the most common route for investors in your situation. Depending on the cost of living in your local market and availability of 2 to 4 unit properties, house hacking may be a strategy worth exploring. Travis Timmons from Houston weighed in and said, my path was owning a business that I sold and acquired real estate along the way. It's going to take more time than you were planning and be harder than you thought. Real estate doesn't pay you well if you need the money. It's like the house knows you need the cash and something's going to break and deplete all of the cash flow for that year. As far as the strategy goes, I would suggest leaning into your current skill set and knowledge to find an unfair advantage. Flipping, short-term rentals, tax liens, etc., are all great strategies if you are good at them, and terrible strategies if you're not. If I had $20,000 to $70,000 to invest, I'd buy a house hack in Dallas if your debt to income ratio is solid. So it seems pretty clear that Rodney, with around $20,000 to $70,000, is trying to escape the rat race, and the people in the forums are saying you're probably not going to do that with 20 to 70 grand. You should start house hacking. Now, why are they saying that he should house hack? It's because they're recognizing that Rodney needs more equity or more cash to invest in real estate if he wants to get enough cash flow to quit the job. And house hacking is a great way to start that journey. You start the time ticking, or you start the snowball rolling of building equity. And when you get enough of it, you can invest it at a return that could provide you with enough income to quit your job. But like Travis said, it's going to take you longer than you think. It's going to be harder than you think. This is a one step at a time journey. This is not a thing that you're just going to learn in 2 to 3 years and then have $20,000 of cash flow coming from your single family rentals that you can just quit that job and that rat race. It's one of the reasons that I wrote Pillars of Wealth, how to make, save, and invest your way to financial freedom, because you got to focus on 3 things: making more money, saving more money, and investing the difference, not just investing to get where you want to go. And in the book, I talk about you got to find a way to make money that you like doing. You got to find a way to fall in love with the process of becoming great. We really want to be chasing excellence, not just chasing cash flow, because when you catch excellence, money will find you and you will have a lot more to invest, which will turn into cash flow. Great conversation here. I appreciate everybody's engagement, and I love being a part of a community that asks questions like this and shares it for everyone to hear. If you're liking today's show and you're enjoying the conversation, please take a second to leave me a 5-star review wherever you listen to your podcast, and comment on YouTube and let me and my production staff know, what do you think about today's show and what do you wish that you could get more of? All right, everyone, let's see. Is it snow cone or is it 1031? Let's get into the next question.
Hey, David, Rory Corporal from Longmont, Colorado here, a longtime listener, first-time poster. So, hey, we've got a mountain property that we did as a burster. We built it back in 2021, and the short-term rental market has really slowed down, but we are sitting on a ton of equity, really thinking about what our next steps are, looking at either a 1031 exchange, and moving that into turnkey properties or an RV park or self-storage, something with real estate involved, or potentially, or multifamily. Another option would be to have a HELOC on it and use those dollars to invest in some other building projects that we're looking at, as well as perhaps buying a cash flowing business. Love to get your thoughts on what we should do with the equity. We've got about $600K that we're sitting on right now. And yeah, love the show. Love what you guys have going on and really appreciate your help. Thanks. Bye.
Rory, he's got the same question we all have. What do we do with this equity and how do we maximize it? When I hear this, especially when we're talking about reloading it into like 10 different asset classes. We got it's self-storage, business, RV parks, multifamily. And again, that comes back to all the noise in the internet now because everyone's promoting that their strategy is the best. And you know what? It probably works really well for them. Anytime that I'm looking at making a trade on equity, I want to put it, if you've earned $600,000 in equity, you did a phenomenal job. You bought the right thing. You grew it correctly. How you execute even higher is buying something that you know and you're familiar with. And so when I'm looking at doing trades, I like to look at what is my skill set and how can I maximize this? Because if I did it with a single family house that maybe I was a heavy renovator, the next transition for me would be into going to like maybe a value add multifamily because it's the same type of asset. It's the same type of product, but a little bit different asset class to increase the cash flow. I have to renovate it like a single family house. I have to lease it like a single family house. And with your short-term talents, you might be able to do 2 short-term rentals and a couple stable long-term tenants to keep your kind of investment more stable, and you can do a hybrid blend. And so I would say you want to audit what do you want to do with your equity? What is the return that you want to make? What markets do you want to be in? And then what products should you be looking at to meet that return expectations rather than just the next hot sizzly asset class? And I think a lot of people are in this jam right now with the short-term rentals. They bought a lot of good property that grew in equity. And as that slowed down, the returns have diminished. And so you're doing the right thing. Is my asset producing me the right return, right yield? And if it's not, reload it out. But do that soul searching, find out what you're good at, what you want to make on your return, then go look at the asset class because each asset class pays you differently.
100%. First off, I don't think that you should have equity burning a hole in your pocket. I guess it doesn't burn a hole in pocket. That's cash. Equity would burn a hole in the house? Don't worry about it though. You don't have to invest that $600,000. You could take your time. Second, just like James said, don't ask the question of, well, what's the best return out there? Because I don't know that there is a best return out there. Ask the question of, well, what do my skills, my opportunities, and my competitive advantage offer me? Do you have opportunities to put that money to place that someone else doesn't because of the background? Do you have a construction background? Do you have a finance background? Are you really good with short-term rentals? And so you can buy more short-term rentals in the same area that you already have some now and get economies of scale. Think like a business owner. And then lastly, James, what do you think about somebody like this lending out, like maybe taking a HELOC on their property and lending that money out, becoming a private lender to other investors?
That is actually how banks make money. And a lot of times people kind of forget that they borrow money and then they relend it out and they make an interest yield. I think that's a great way as long as you are not jeopardizing your own asset. Before you do that, you really need to know how to vet a loan. You need to vet the operators, and in the more experienced your operators, and the more you understand how to vet a hard money loan, the less risky it is. I do thousands of hard money loans a year. Between our company and myself privately, I have a default rate over a 16-year span that's less than 0.25%. Or it's less than, it's less than 1%. I've only lost money on a loan less than 0.25%, but that's by underwriting the borrowers. I'd be cautious about taking out a HELOC if you're going to get it. Right now, HELOCs are around 9%. you're going to re-lend it out about 11 to 12%, or maybe get some equity in there. And so the yield's small and the gain would be small for you. And so make sure that you really understand it, because you don't want it being too high of risk for that little return. If it was me, I would look at 1031 exchanging, go buying a property so I can get that depreciation right down the taxes, and then maybe pull some out to invest it in hard money separately, so you're not taking on more leverage. I'd rather pay the tax than take on more leverage and have a smaller yield. Hard money is a great space if you want to make cash flow. The one negative is you pay high tax. You don't get all the same benefits as you get from owning a rental property, the appreciation, the depreciation, the write-off expense. It's ordinary income. You're going to pay it. It's a high, typically I'm paying 40% tax on my hard money loans, and there's not a lot of relief there, but it is steady cash flow. And it is how I live my life today. Everything I do today is paid for by my hard money passive income.
Great point, James. Different opportunities come with different pros and cons. And one thing that creates analysis paralysis is investors that are trying to find the one option that doesn't have any downside, but you're not going to get it. If you're trying to avoid the tax implications, you're going to take on more work or more risk. If you're trying to get the best return possible, you're probably going to have to learn a new thing. If you're like, man, I just want a high return with no work, you can put it in a retirement account, but you're not going to be able to use the money for something else. So the key is to look at the downsides of every single option and find the one that the downsides affect you the least. All right, our next question comes from Dan Way in Madison, Wisconsin. Dan says, I'm wondering how saving money in the future through refinancing would look. Most of the time I hear about refinancing, it's when rates are lower than when you originally purchased the property. How can we ever expect to lower our monthly payments without the expectation of seeing lower than 3 to 4% rates? I'm looking to find my next property through Fannie Mae loans for the low down payment aspect. However, the monthly payments associated with these properties with the low monthly down payment make it almost impossible to cash flow, which I understand is harder to find in this market at this time in this first place. But how can I even rationalize these deals with little to no possibilities of lowering those monthly payments in the future? All right, so this is an interesting question here, James. If you're getting in at a 3 to 4% interest rate, you have no possibility of really refinancing any lower than that. It's hard to picture rates getting lower than that. But if you're buying property now and you're waiting for a refinance for rates to go down, you don't feel like you're in control of your own investment future because you don't control when the rates are going to go down. And it looks like Dan's thinking, hey, I'm willing to buy a property that doesn't cash flow right off the bat if I have hope that I can refinance these things in the future. But how do I rationalize these deals with little to no possibility of lowering the monthly payment in the future? So the question is, should we be buying real estate right now if we don't know that we can refinance into a lower interest rate later? What's your thoughts there?
I think one thing I would really remember is interest rates, cost of money is just the cost of the deal. And, I don't make my investment decisions based on interest rates. I make it based on cash flow and returns. Very recently, I just traded a property that cash flowed $1,200 a month, and I had a 4.25 rate on it. And I traded it for a property that basically breaks even, and I have a 7% rate on it. And there was a purpose to that. I think a lot of investors get caught on that rate. They're like, I can never get rid of this rate. And I wouldn't look at it that way. I would look at, okay, if it's not working for me, I need to explore other markets that give me a better return. I think it's important that you evaluate, hey, here's my strategy. You came up with my strategy. I'm going to use a Fannie Mae loan to buy a rental property with low down. I'm going to get better financing than an investor. That is your strategy. Now it's going, how do I execute it? And maybe the market that you're looking in right now is just not working, and you need to go to outside markets because you can cash flow in this market. You just might have to explore cheaper ones. If that is your plan, I would go find the market that it works in, utilize that loan, and then look at pivoting your strategy out later because you can only do so many low down loans anyways. I would utilize it, put that money to work, but change how you're implementing it, not how you're doing it.
That's a great point. I'm also not a huge fan of that. I have a 2.5% interest rate. I can never let it go. I've never heard a person who did really good in real estate. And when I talked to them about how they did it, they said, well, you know what? I got 3% interest rates and I held them the whole time. They always talk about the deal. They talk about the property. They talk about the increase in rents. They talk about the increase in value, which is usually a function of the location that they bought in or the time when they bought. It's never about the rate. And so I just don't know why we put so much emphasis on that other than the fact it just stings that it used to be better than it was. But isn't it always like that? We talk about 2010 real estate. It used to be better than it was. I wish I had bought then. In 2016, everybody thought that real estate was too expensive compared to 2010. Now in 2024, we look back at 2016 prices and say, oh, I wish I had bought then. And you know what? In 2034, we're going to be looking back at 2024 prices and saying, oh, I wish I had bought then. We are not going to be thinking, well, the interest rates were 7.5%. And so it didn't make any sense to buy. It never actually works out that way. So try to take your attention off of the rate and try to think about the other ways real estate will make you money. Can you get a tax advantage from it? Can you shelter income from other things with it? Can you set it up to where you're making extra payments on your principal and pay it down quicker? Can you add square footage to the property? Can you add units to rent out? Can you buy in an area before everybody else gets there? That's the next up and coming emerging market. Let's just think a little bit more than just what fits into the spreadsheet. And sometimes those answers will pop out. All right. And that was our show for you all today. Just a little recap here. We talked about networking for commercial properties and how to build a pipeline, whether you should keep a property because of the interest rate or think about the overall returns, what to do to escape your 9-to-5 with $70,000, and how to handle the problem of having a whole bunch of equity and not sure what to do with it. Thanks again, everybody. We love you. We appreciate you for being here. I know you could be listening to anybody to get your real estate investing knowledge from, and I really appreciate the fact that you're coming to me. You can find my information in the show notes if you want to reach out to me personally, and if you've got a second, let me know in the YouTube comments what you thought about today's show.